David Rosenberg, okay? Great to have you here today. He's founder and president of Rosenberg Research, chief economist and strategist. David, I ran into you, as I was telling you before here, on a podcast you were doing, and I was just completely captivated about your understanding of the economy, inflation, the current situation going on, not just in America, but around the world, and I appreciate your time here today.
Well, and I appreciate the invitation, so thank you very much.
Yeah, it's crazy. I was just in your neighborhood Sunday, and I don't know why I didn't know you didn't live there. As soon as you told me you were in Toronto, I'm like, oh yeah, I knew that. But how long have you been up there?
Well, I was actually, I've been in Toronto for the better part of the past 4 decades, except for the 7-year stint when I was in New York for Merrill Lynch from '02 to '09. But Toronto has been the base, and before going to become the chief economist of Merrill Lynch in New York, I was the chief economist and strategist for Merrill Lynch Canada. So I was the ambassador for the 3% of the world, otherwise known as the 51st state.
Yeah.
But this has been home really for almost my entire adult life.
And I see you're a big reader. You got all those books in the background. Like what do you typically, or what are you drawn to? Is it all economics or other stuff as well?
Grant, that's a mural. No, I'm just kidding.
Yeah, okay.
It's the key is to read the introduction and then the last chapter. Just cut to the chase and forget everything in between. So that's a second joke. You see, in economics, if you don't have a sense of humor, you're going to put everybody to sleep.
Yeah, well, that's what I liked about you, because you know I could listen to you.
There's a whole hodgepodge of books up there of politics, science, religion, the arts. There's a few sports books. I guess mostly, though, economics and business and finance for the most part.
So, David, what's going on right now? And, I'm 65 years old, and, I've heard for 40 years now that we have too much debt. Now it appears that we finally have too much debt. Is debt the issue that everybody says it is?
Well, it depends what the conclusion you're going to draw. Is the question that does debt matter? Well, of course, debt matters. And from my perspective, and I think that we could take a look at, Japan, or even take a look at China. We could look at the United States. We just come through the debt ceiling file, and we're going to add on even more debt. We're a piker when it comes to some of the other basket cases in the world. Japan has lived fine with record levels of debt that are in the stratosphere compared to where they are in the United States. I know we bellyache a lot about the debt. China, look what's happening there. And of course, when you get into real estate, for example, in China, and the delinquency default cycle that takes place, it creates financial difficulties. The problem with the debt is when it becomes an impairment to refinance, and then you go into a default cycle and a classic credit crunch. There's reasons to be concerned in the United States when it comes to the regional banks right now, which is something that's a little bit separate. But the way I look at excessive debt is that it is an albatross. It is a weight on the shoulders of the economy, because even at low interest rates, when you have that much principal to pay off, it's a constant drain on aggregate demand. So it's actually deflationary. That's why the two countries that have the biggest debt burdens, Japan and China, also happen to have the lowest inflation rates. In fact, China right now is battling with deflation. And so it's a dead weight drag on spending, because every dollar of debt you're taking on today to finance current consumption is a dollar that is being sacrificed for future economic activity, and then you got to service that debt. So is it a disaster? No. It is a constraint, however, on demand, and therefore it is disinflationary, not inflationary.
Meaning if I can't get debt, I can't buy things, so prices drop because supplies go up.
It's like this. It's like the debt gives you, the instant sugar high. But the thing is that you're going to take on debt to buy your automobile. Well, you're not going to go out and buy a second, third, and fourth automobile. You've already bought that automobile on credit. Then going forward, you've got to finance that. And so when you finance that, especially when interest rates go up as they have, it means you're going to take your family out to the restaurant one fewer time a month that you normally did in the past. So that's what I mean. That debt. I mean, look, a modern economy is going to be financed by credit to some extent. It's a good thing we have credit, but there's also such a thing as too much of a good thing. And I think that the industrialized world, and even standing in China, for example, you reach a point where it's the first thing you learn in Economics 101. You learn about the laws of diminishing returns, which is when you stuff yourself just too much of the smorgasbord, and then you get a very bad case of indigestion afterwards. Years ago, we crossed that threshold where too much debt acts as a tourniquet or a constraint on economic growth. And that's why, you can tack on other things. Aging demographics, of course, leads to lower economic growth because you retire, you spend less, you earn less. And we know that's going on. But the debt burden has a very similar impact in terms of the constraint it has on economic growth. So if you're taking a look, for example, at a chart of, say, 10-year average real GDP growth, and you can do this for almost any country, and especially with countries that have had high and rising levels of indebtedness over the generations, you're going to find that that 10-year rolling GDP growth is getting lower and lower and lower and lower.
Is that for every country?
Pardon me?
Is that for every country?
Every country, but it's not linear. So then countries, for example, where the debt burdens are even higher, the weaker that trend growth has been. Japan is the poster child for that thesis.
So, and Japan has their debt, because it sounds to me like we went through this COVID thing. When COVID was no longer popular enough for the government to sell, we went to war. That wasn't very popular, supporting the Ukraine war. Then we moved into this inflation. The new invisible war is on inflation. And people say, well, we printed too much money, it creates inflation. And I'm under the belief that printing money does not create inflation. People doing stupid things with money is what creates inflation. Where do you stand on the relationship between debt and inflation? Because what I'm hearing you say is it's actually deflationary, not inflationary.
Yeah, well, the debt. Well, what happens is that the increase in debt, say in time A, will give you this sugar rush right away, and then that creates, say, spending, some near-term inflation because it creates that initial demand. Next thing you know, well, you got to service that debt, and you just whatever it is you did with that money, whether it's the government borrowing, business debt is different because businesses, aren't borrowing to buy cars. Businesses aren't borrowing to go on a vacation. If business debt is being raised for productive purposes and grow the capital stock, well, there's an internal rate of return. Corporate debt's different than, say, household debt. So we're going to borrow money and go on a vacation. We're going to borrow money and we're going to, go buy a house, which is, of course, you can argue an asset and a consumption good at the same time. Business debt's a little bit different. Government debt, well, we all know government debt most often is pretty wasteful unless it's being used towards infrastructure. Like I would say that the debt that FDR took on with the New Deal in the 1930s. I mean, the New Deal had a lot of really funky stuff in it, a lot of resource misallocation, but a lot of the bridges, the dams, the waterways, the transportation infrastructure, that you see today was actually built in the 1930s. So that had a great long-term internal rate of return that more than compensated for it. So it can be done smart. But the in terms of the long-run impact on inflation, the debt is deflationary, and we're going to find this out in real time because the one thing. Okay, they raised the debt ceiling, that's great, but spending is now going to be flatlining for the next 2 years. I guess that the Republicans could have tried to roll the dice to get actually the Democrats to get onto not just spending caps, but spending retrenchment, well, that wasn't going to happen. But we're going to be having no fiscal stimulus for the next couple of years. As far as I'm concerned, that's a good thing, but that's going to have a restraining impact on aggregate demand that hopefully is going to help the Fed do its job in terms of reversing the inflation bulge. I think your comments on inflation are 100% correct. It created, you see, the money printing you talked about, it did cause an initial sugar high. And it was really money that was being printed to finance the massive explosion of government debt, to pay people not to work, to pay people to stay at home. There was other, medical expenses involved with the pandemic, but it's all in the rearview mirror. So what you try and do as an economist is isolate what is a temporary shock and what is an ongoing recurring shock. You see, the 1970s was different because that was a recurring annual shock every single year. We're not going to get a pandemic every single year.
Right.
Hopefully, Putin's not going to start a war every single year. And so this was really, and when you look at the money supply, it was a temporary money shock. Very huge money shock. All of a sudden, we do have inflation at 9%, to your point. 1 month of inflation at 9%, June of last year. Indeed, who was calling for that? Not even the most ardent bond bear or inflation hawk thought we were going to have 9%, but we're there for 1 month, right? And when you go back to the 1970s, we had a 9 handle on inflation or worse 2/3 of the time. For all the people that compare. But you see, you have to differentiate between what is recurring, and what is a one-off shock. And this was always a one-off shock. This was always going to be transitory. Now, people laugh when I say that, but the reality is that, I don't know, I think in the overall annals of economic history, 18 months is pretty transitory. But you see, we're so narcissistic and impatient, and we can't see past the tip of our nose. Today, the investor class today, it's like long-term is like lunch next Wednesday. But, the last time that we had a pandemic and a war, now, of course, we had the war, then the Spanish flu, World War I, 19. So we had a period from 1915 and 1920, 5 years where inflation was over 10%. And then we went through the 1920s. Now, I guess, would we call over, 130 years, would we call
3 events,
5 years transitory?
Yeah.
Now, when you're living in the moment, it's not transitory. And then this time, 18 months of inflation didn't feel transitory, but it was transitory. What's interesting is that the 1920s, after those shocks were over, we had a decade of price stability or deflation. And you go to F. Scott Fitzgerald wrote The Great Gatsby in 1925. Not one mention of the big inflation from 1915 and 1920.
It was
not one mention.
Time. Yeah.
So I think your point is 100% right. You have to differentiate what is a recurring set of shocks that are more permanent, insofar as anything is permanent, and what is really truly transitory. And so everything you're talking about, 100% correct, by the way.
Yeah. So
the money shock, the debt associated with the money shock, the fiscal shock. 18 months.
Let me ask you this. So if you had a preference, and what I'm trying to do is simplify things for my audience. I got a lot of real estate investors here. I got a big real estate portfolio. You mentioned this impairment to refinancing properties because interest rates start fluctuating. We'll talk about that in a second. Do you want, as an economist or as a businessman or a household, and they might be a different answer, do you prefer deflation or inflation?
Well, it's a really great question. We if you look at the centuries worth of data, if you go back to 1,000 years worth of data, if we could do that, you'd find that in peacetime, when we're not at war, we actually have deflation. And we only had war historically. We only had inflation when we had global wars. But we have a different economy today that is not as flexible as it used to be. Like, for example, the labor market is not quite as flexible as it used to be. It's not as rigid as it was in the 1970s. I would say that the the problem with deflation, with the levels of debt that we have, is it would cause a much more dramatic delinquency and default cycle, because when you go into deflation, it impairs cash flows. Cash flows deflate. The cash flows needed to service the debt. And the problem is that unless you can bring interest rates below zero, now look, these central banks did quantitative easing to create a synthetic negative interest rate. But let's say theoretically, interest rates can't fall below zero. Then what happens with the deflation is it makes it that much more difficult to meet your debt obligations. And you go into a spiral of delinquencies and defaults that then cause demand to contract even more, and you go into a deflationary spiral. If we didn't have all this debt, my answer would be a little bit different, because I would say that probably a little inflation is better than a little deflation. And centuries ago, I wouldn't say that. And I would say that actually modest deflation was pretty normal. But it would be really problematic today to even have mild deflation, considering the massive debt burdens we have really across the OECD. Inflation, it depends how you want to talk about what is unacceptable inflation. So we have these central banks that have decided by fiat that 2% is the holy grail. We actually did work in my firm a few months ago showing that inflation between 3 and 4% actually is the sweet spot. Now, the central banks have, they've become almost like religious fanatics trying to chase 2% holy grail. But we actually found that, and we just looked at the US, but we found that actually the periods of the greatest economic stability, tranquility, well-performing labor markets, well-performing capital markets, actually the sweet spot is closer to 3 to 4 than say 1 to 2. And so I would say modest inflation, if you can achieve that, and I think we actually have it today. I mean, the Fed wants to desperately to get down towards 2%. But I would say that the problem with inflation much above that is it's a tax on the poor, and it's a tax on the elderly. So you want to keep it sort of range bound, say 2 to 4%. I don't think I would try and get it to negative with the debts we have. That would be not a good economic policy. And this is all about fine tuning in a certain range. But I'd say that inflation between, I would just say, call it 2 to 4, 3 to 4. When I talk to people about 3 to 4%, because everybody's been brainwashed to thinking it's got to be 2. It's got to be 2. I'm trying to say, here's my research showing that actually there's nothing special about 2% inflation, but the central banks started with the Reserve Bank of New Zealand back in the 1980s, followed by the Fed. What's very interesting is this. And it comes down to how do you want to define inflation to begin with. In 1996, July 1996, and this is in the FOMC transcripts, just to show you what I do for fun. You read these FOMC transcripts that come up with 5-year lags. It's like reading a Shakespearean tragedy. It's a phenomenal document. It's hundreds of pages, but it's not the minutes, right? It's the actual meeting. It's the actual transcripts. And so Janet Yellen, who was then a governor, is all over Alan Greenspan. And she was trying to push for inflation targeting. And she says
she wanted inflation.
She wanted inflation targeting. Let's talk about the number. So, the thing is, I'll tip my hat to Alan Greenspan was trying to push back on all these, this inflation targeting. And he even said, we're going to target the CPI, and it's such a flawed statistic, and it is terribly flawed. He didn't want to get hamstrung to one particular number. And she says, well, how would you define price stability? He says, well, purely defined, it's 0, But he says, actually, it's not a number. It's not a number. Even when you ask me the question, it's not a number. This is what I'm trying to say in my daily, every day, a memo to Jay Powell. It's not a number. It's not a number. It's about when is inflation not influencing or distorting decision-making in the business sector and in the financial markets. At what point, you see in the 1970s, the inflation expectations were so embedded that companies continue to build inventory. You built inventory because you didn't want to pay for it a month. But by building your inventory this month, you created that extra demand that caused the inflation, and it becomes a spiral. That's why we had the spiral. The same thing happened in the household sector. If you think, I'm going to go to the supermarket, what do I buy? If you think prices are going to be going up 10% the next month, you're going to buy as much as you can right now. And therefore you create that demand inflation. It becomes self-reinforcing. So these things are difficult to measure. But the beautiful thing about having created a market, as they did 30 years ago for inflation index bonds, is everybody can see what is the market, what are the liquid markets, what are investors telling you about their long-term view about inflation. And as we sit here today, when you look at what's called the 10-year TIPS break-evens, which is the bond market's way of saying this is our long-term structural view of inflation, that number, as we sit here today, as everybody is going wild over the inflation as they're fighting yesterday's war, those 10-year TIPS break-evens are basically 2.2%.
Where's that? Where do I find that? I've never heard that. The 10-year TIPS break-even?
Yeah, well, if you subscribe to my research, I talk about it every day, but you can get it on Bloomberg.
Okay.
You can get it on in a Bloomberg terminal. I think that actually, if you just Googled 10-year TIPS break-evens, there's probably going to be a quote that would pop up on your computer.
Okay, and then what is your research paper? Tell me the website.
Well, so if you go to, you could just Google Rosenberg Research. It'll take you right to the website.
Okay.
Or you can just information at rosenbergresearch.com. But most people what they'll do is they'll Google Rosenberg Research. My website shows up right away.
Okay.
I publish, 12 different products daily, weekly, monthly. And just for you and for edification for everybody on the call, I give a 30-day free trial of everything that I do. Verbal and written.
Good. I'm a slam a bunch.
Stuff we're talking about, like that's why, and I'm glad that I brought that up, because when somebody tells me, it's one thing to tell an economist, oh, nice forecast. The thing is, forecasting is a mug's game. A lot of that is luck. But I'm glad that you said to me that when somebody like yourself says to me, you told me something that I didn't already know. That makes me feel good.
Yeah, I mean, I don't know. That's why I have you here. I know I've been very successful in my career. There's a million things I don't know. And what you're telling me, I think, is this 10-year TIPS break-even is telling you that interest rates are going to go back to 2%.
That's 100% right. It's telling you actually that what it's telling you is back to your question from a few minutes ago. It's telling you that inflation is not having an influence on market behavior. And if it's not having an impact on market behavior, it very likely because the financial markets and the real economy have this symbiotic relationship. And if you're a central banker looking at this, or anybody, you'd be thinking, okay, we know that inflation is a lagging indicator. We know we had an inflation bulge. We know the reasons why. We had
supply. Was it supply or supply chain problems, or interest rate zero?
It was a combination. It was a combination of the pandemic.
Yeah.
The shutdowns, all the global supply chain problems that came with the pandemic. But then we inherited something horrible. Well, two things. Firstly, China, world's second biggest economy, really an entrepot for manufacturing, a manufacturing hub, especially for Asia, but it has knock-on effects globally for a period of a year. In 2022, God forbid, China, they got 5 cases of COVID. They're shutting down port cities of 20 million people.
Yeah.
And that was cost-push inflation globally. And then Vladimir Putin thinks it's a good idea to invade the Ukraine. And so that created global
Some people think he was forced
on energy
into that.
and food, spin-off effects. And what are you going to do? We have shock. So we had supply shocks, but then we had the lingering impact of the fiscal stimulus, right? And so that created other problems. Like, for example, look, there's no doubt that if the government's going to pay people not to work, which is crazy, people are getting unemployment insurance checks that were bigger than their previous paycheck were. So why am I going to go back to work? So that causes businesses to say, if I got to get these people back to work, I got to pay them even more, and then restore my margins. I got to raise prices. There were all sorts of really stupid stuff going on in Washington that was unnecessary. And then, of course, the Fed, like you said, goosed the money supply. That's actually reversed. Now the money supply is negative, so we've corrected that. But it created that. So what happened is that, and so there's people that you talk to that still think that inflation is the number one problem. Inflation's coming down. The market-based numbers, like I said, and you could do 5-year tips break-evens, 10-year tips break-evens. You could do all sorts of different maturities across the bond markets, telling you the same story, that the markets believe inflation is going back down to 2%. And then there's other survey data. There's surveys of consumers, for example, and surveys of businesses that are telling you the same thing. Now, the thing about inflation is not the S&P 500. Inflation is not the NASDAQ 100. Inflation is not Bitcoin. It's a slow-moving animal. I mean, for an economist, watching inflation, it's an exciting situation for an economist. It's a race between watching paint dry and grass grow.
Yeah.
But it's coming down. We talked before, 9.1% was the inflation rate at the peak June of 2022. Today it's 4.9%. People say it's still too high.
Yeah, 50%.
But it's moving down substantially. In fact, that's a 10-month period where the inflation rate has come down 420 basis points. Has only happened 3 other times in the past 7 decades. It happened in 1975, it happened in 1982, and it happened in 2009. So it is actually coming down quite substantially. And I think it will continue to come down. And that's why, by the way, I'm very, quotes, bullish on interest rates. I think that the Fed is done. And I think that we are, we're past the peak of growth. We're past the peak of the economic expansion. We're past the peak of inflation. And guess what? As we're seeing with what's happened with the regional banks, we are past the peak of the credit expansion. So we're into a new part of the business cycle, which is the contractionary part. And in that part, by the way, interest rates come down.
So why is Jamie Dimon, why are the rich bankers, Jamie Dimon, David Solomon, some of the big, Ken Griffin, why are these big shot billionaire guys saying, hey, we need to keep rates up and we have further to go? How do they benefit? What is the game there to squeeze out middle class America with these high interest rates?
Well,
second part,
look,
and David, I also want to know this.
Yeah.
Do high interest rates also cause some type of weird inflation? If my mortgage doubles.
Right. Well, actually, it's a very interesting. So I'll answer the second question first. In a very sort of unusual, arcane way, the answer is yes, because one of the areas of inflation, people talk about service sector inflation. I'm looking at the data. Airfares are now starting to come down. Why would that be a surprise? Look what oil prices are doing. Hotel, motel rates are coming down. Delivery services, think UPS, FedEx. The data showing those numbers are coming down. Financial services, that's been a source of inflation in the past few months because the banks are being forced now to raise their deposit rates. So all of a sudden deposit rates go up, you get some inflation. So I know that sounds weird, 100% true, but when you're taking a look at the economy from a holistic standpoint, from big picture, higher interest rates, especially with these debt burdens, reduces demand growth. And then what's inflation ultimately is how are the supply and demand curves moving? What's the shape of those curves? What's the direction? And what interest rates do in both directions, they influence demand relative to supply. So higher interest rates, always and everywhere, will tend to have more of a downward impact on inflation, notwithstanding the statistical impact it has right now on financial services inflation. About the central bank CEOs, and having spent a good chunk of my life before I started Rosenberg Research working at banks, look, these bank CEOs, they're regulated by the government, correct? I don't think you're regulated by the government. I know I'm not regulated by the government, but the banks are regulated by the government, so they are quasi-politicians, okay? So the problem why a banker would not want to say rates have to come down is because what does that mean? It means the economy is going to be sucking wind, for lack of a more sophisticated term. No central banker and no banker on Wall Street is going to come out and say the economy is in such bad shape, rates have to come down. They're always putting on a happy face. I mean, you watch these Jamie Dimon or Brian Moynihan or Gorman, they always have a happy face because they have to. They're public figures.
Yeah.
So that's basically it. They're always,
but do they benefit?
They're always bullish on the economy.
Yeah.
So of course, you don't want to. If you're bullish on the economy, you do not want to say rates are going down.
Yeah, but don't rich people okay, benefit from earning 5 and 6% at the bank when the rest of the world is never going to get that rate. You know, but they're paying 14% for the used car. They're paying 7% for the mortgage. Bank of America came out, 9 months ago and said, we now want to help minorities buy homes. I'm like, damn, interest rates are 7.5 now. Why did you wait till then to do it? Why weren't you offering minorities that when the rates were 2.5?
Well, look, this was you're 100% right, and all of these issues with ultra low deposit rates got exposed with the demise of some of these regional banks. And what we found out is that bank deposits aren't so sticky after all. But no, in answer to your question, the general public just wasn't paying attention, right? Because the money market mutual funds, they move with treasury bills, and the treasury bill yields were moving with the Fed. So people were having, maybe in their savings accounts, earning 0 to 1% this whole time, but they could have actually been just buying money market funds. Now, look, I'm talking about for households. For businesses, it's a little different because, small businesses like my own will have deposits at a bank. I'm not going to have my money in a money market mutual fund, and very, very low paying, and you have to basically live with that. Because you have to have that store of cash in the bank to meet your payroll, and this is where relationship banking gets in with small businesses and the banks. But for households, you're 100% right. But people weren't paying attention. But look, the reality is that if the banks couldn't lend out at a spread between their lending rates and their deposit rates, and they didn't have a margin, they wouldn't be in business. That's the business of banking. But you're right, the margins were radically inflated because the banks were able to take advantage of the fact that people up until recently weren't moving their money out of their deposits. But
now they're awake.
SVB and the others is woke them up. All of a sudden, you had these ballooning inflows in the money market mutual funds. Now the banks have to play catch up, and that's what's happening. By the way, this is going to be very challenging. Role reversal. Now the banks are going to be facing a much more challenging NIM, net interest margin experience, and it's going to come at the expense of their earnings over the course of the next couple of years.
Let me ask you now, guys, man, I could sit here and talk to you. I got to come just visit with you and just listen to you for 3 hours. We printed, $7 or $8 trillion here in America. Every other country printed, by the way, at the same time. And I learned in my accounting, there's a constant in math. And I've been saying for some time now, if everybody prints at the same time, did anything really happen? If we all printed equally. Number two is if we printed $8 trillion, when a bank gets a deposit, don't they lend that out 9 or 10 times?
That's right. Fractional banking reserves. 100%.
Yeah, so if we printed $8 trillion and a portion of that was lent out again, that means there could be somewhere between 40 and $80 trillion.
Yeah.
Inflation didn't happen at those kind of levels. Like, we printed more money than inflation that we've had. Is that unfair thinking? And then what about the constant that everybody printed?
Okay, let's go to the constant first. There's a lot to unpack there. So if there's just one country, say the United States, goes through that money printing exercise, because of the supply of US dollars is going up, it would mean the US dollar would go into a real big bear market. But the fact that we were all in this together meant that there was no big change in the foreign exchange market. So the impact to what you're talking about really means that there was no, call it beggar thy neighbor, foreign exchange policy here, that we're going to deliberately weaken our currency through monetary policy. All in together, everybody. And so what happened, of course, is that, that's why you had stuff like Bitcoin going up and Ether going up and land prices going up and hard assets, gold, precious metals. For a while, they're commodities. All of a sudden, in April of 2020, the oil price average is $16 a barrel. Next thing you know, 2 years later, we're over 100. And of course, we peeled back since then. But Hard assets that weren't going up nearly the same degree of supply, well, that's where you had the increase in prices, relative prices, say relative to the US dollar. But the yen, the euro, sterling, Canadian dollar, they didn't really move. Nothing really moved. And that's where that impact is in terms of like, well, nothing happened.
Right.
Well, because in the foreign exchange market, it was telling you that we're all doing this together. However, we're all in this together, and we had a temporary inflation boost because of all the money printing, debt financed money printing, classic economics 101, but it's over. And so what it did was we're basically, 1 day older and one extra dollar in debt, and then we got to service it. So what I said before, every country shared this, the sugar rush and now the hangover. Mm-hmm. And so that's what we're all sharing right now. Trying to remember there's a secondary question.
Yeah, the 8 trillion, the amount of money, which could be somewhere between 40 and 80 trillion dollars in new money. So, but we didn't have that kind of inflation. Homes didn't go up 8 or 10 times. I'm just saying we printed more money than inflation that we've experienced, even though inflation, the new boogeyman, is everybody's big invisible threat.
Great point. I mean, you would have said, hey, we doubled the money supply, but inflation went up 9%. Like inflation went up 1/10 what the money supply did.
Yeah.
And the money supply is just basically, the liabilities, and then the assets are all the credit creation. So they match each other. So your comment is we created all this money in credit, and inflation we should have had like Zimbabwe type inflation, and we didn't. What does that mean? It's what I said before. It's the first thing you learn in economics as a university student. You learn about the laws of diminishing returns. Too much of a good thing. And so there might have been a time 50 years ago when our debt ratios were much more reasonable and low that we would have had a much bigger inflationary thrust. But the problem is because we don't have the same credit and money multiplier that we used to have, because the debt is so bloody big that you don't get the same impact on the economy or on inflation. Because you could say the same thing. Look at the fiscal stimulus. We should have had like 25% growth. Growth was pretty good. It was like, call it 7-8%, back in the peaks coming off, and we had the reopening trade. But I'll tell you the truth, despite notwithstanding how great the economy did with the reopening trade and all the gobs of debt financed stimulus, it was never what you would have gotten had the starting point on the debt ratios been a lot lower. And that's what I'm talking about. Look, we could go back to, say, the Trump tax cuts. Trump tax cuts start in 2018. And we had a brief sugar high. The Fed raised rates a few times. Next thing you know, the Fed is cutting rates in 2019 and the economy is sucking wind.
Yeah.
Same thing. So you gave a sugar high. Now, it wasn't spending. It wasn't COVID spending. It wasn't paying people to stay out of work. No. Well, we cut taxes with $1 trillion deficit. And next thing you know, we have a quarter or two of pop and growth, and then we just roll over.
But we rolled over because of COVID.
Pardon me?
We rolled over because of COVID.
No, I'm talking about 2019. Remember, we started to roll over 2019. Remember, that was the Powell pivot.
Yeah.
Who thought after the most epic tax cut of all time that the Fed would then cut rates 3 times in 2019 before COVID? Why? Because the economy, you had the sugar rush, and then the sugar rush, and this is the lesson. And then we're choking on the debt after that. We're choking on the debt. You see, that's what I'm talking about. We're stuffing ourselves with so much food, and it feels great until you bust the button on your trousers. It doesn't feel so great anymore. And we're just reliving that. And that's why, by the way, the trend in growth getting weaker and weaker. We get these little sugar highs by the politicians, but the debt's too big. The debt's too big, and it's an ongoing constraint on the economy on a trend basis. I'm not going to talk about, we had such a great quarter here and a great quarter there. Yeah, it's really a distortion. It's a blip on a trend line. The trend line in economic growth, for 2 fundamental reasons: excessive debt and aging demographics. Mm-hmm. And we're all in this together. There's maybe only 2 countries that don't share this affliction, and it's Mexico and it's India. in terms of the
Meaning
demographics.
Mexico and India have a much younger population.
Very young, very vibrant.
Yeah.
They are, and right now, no surprise, surprise, they're the only country in the world whose economy is growing more than 6%. You got to go back 30 years. Last time the U.S. economy grew, more than 6% outside of the distortion related to the pandemic.
Okay, so tell me then, man, again, I think this is why so many people check out on money. They just give up on the money game because it does require a bit of a moment to study it. And I appreciate you studying it for your whole life and making it simple for people to listen to. M2 money supplies at 1933, lows back to 100, almost 100 years. How can we print so much money? Or maybe I don't understand what M2 money supply is. How can we print all this money and have a collapsing velocity of money into the marketplace?
Well, it's because there's too much debt. So that's the problem. Is that you're it's like you have it's like the leaky boat syndrome. You're filling up a boat and the boat's leaking out. So it's as you're creating more and more of the money supply, you're getting less and less and less. I mean, because the velocity of money is just the ratio of the money supply to GDP. It's just a ratio. So what it's telling you is we're getting less and less of an impetus. As you said, we should have had much stronger growth with that money supply boom. By the way, now the money supply is contracting. But we should have you said it. We should have much stronger growth. We should have much higher inflation. Why? Why didn't we? Because we're choking on too much debt. So that's had an impairment to the credit and money multiplier. We're just getting less and less impetus out of the stimulus because of the excessive indebtedness.
Yeah, so how we're choking on too much debt, meaning that paying for the debt, paying the interest on the debt is using dollars that we could be buying goods and services?
And it's the same in the consumer sector. It's the same with record. Look what's happened with credit card debt over the course of the past 6 to 12 months. It's exploded.
Yeah.
At a 24% interest rate. And you're starting to see, by the way, subprime auto loan delinquency rates are going up a lot. Credit card delinquency rates going up a lot. Mortgages, well, not so much because 85% of the population refinanced at these very low rates, but then we're prisoners in our home. But you're starting to see the strains, absolutely. We come off the most pernicious interest rate cycle since 1981 with a record debt level. And not just in the government sector, but in the household sector. And you're seeing it in the business sector as well. So it's not just the government debt, it's the total debt burden. And people say, well, where's the recession already? Where's the recession? I think it's actually already starting. And there's no doubt that these things take time. The Fed started raising rates in March of 2022. We're in June of 2023. Normally it takes a year to 2 years before the first rate hike filters into the economy because the economy resets. The economy naturally resets with a lag to the new interest rate regime. And so we're going to have the double whammy of not just the higher rates on the debt and the debt servicing that comes out of incomes and cash flows, but we're going to go into a cycle where demand goes down at the same time. And that has an impact on the denominator, otherwise known as income. Income in the personal sector and profits in the corporate sector. And that's what leads you into, and this is just the cycle, higher delinquencies and higher defaults, and which begets the next question, because you asked about the banks before. It's interesting you asked about the banks. But they're the bankers with their smiling faces. And as they tell you, well, rates have to go up because they want you to believe we're going to have great nominal GDP growth. The question is, why are these guys then raising their loan loss provisioning? Why are they raising their provisions for loan losses? Because they know. So don't judge these bankers by their words, judge by their actions, that they are preparing for a negative credit cycle coming in the next year.
So if we go into a recession, have you ever seen a recession, at least in America, that did not result in lower interest rates?
Even the god awful ones in the sclerotic stagflation 70s, interest rates came down in recessions. Even when we had stubborn inflation.
So if we have two quarters, of a recession,
Yeah.
I know they added this job numbers now to change the definition. They conveniently change the definition of everything nowadays. Since they pulled it off with the vaccine, now they're like, okay, inflation. Oh, we got a job number. We're cool. But if we have 1 quarter of inflation of recession, how much do you predict the interest rates will pull back? If we have 2 quarters, what kind of effect historically has that had on interest rates?
Well, look, if it's 1 quarter, it won't be a recession. It'll be what the economists call a soft landing. It'll be a short period of weak growth. And in that situation, I could see interest rates coming down, call it 50 to 75 basis points. So they'll come down, but not by a whole lot. If we get a real recession, and look, the business cycle's not dead, and this is not about, oh, the boy who cried wolf and the sky's falling. Recessions, we've had, 13 of them in the post-World War II period. Thankfully, 85% of the time we're in expansion, 15% of the time we're in recession, 85% of the time we're in a bull market, 15% of the time we're in a bear market. So thankfully, we're in a bull market and economic expansion more than we're in recessions or bear markets. But for economists to come on and tell people, that we're going to emerge from the most pernicious Fed tightening cycle since 1981, is to tell people that interest rates don't matter, which is the stupidest thing I ever heard. Maybe the best economist of all time was a physicist, Nobel laureate named Albert Einstein, who famously said that the power of compound interest is the eighth wonder of the world. Interest rates, especially in a credit-driven economy, they matter. They just affect the economy with lags. Mm-hmm. Or it's like akin to saying, even if you think we're going to have 1 quarter of a blip,
yeah,
I put very low odds on that. I mean, I don't believe in 0. I don't believe 100. You got to play probabilities, but I would say that the odds that we get through this without a real recession are as close to 0 as anything could be close to 0. Okay, so if that's my view, and economic and market forecasting is always, you'll get 10 economists in a room, they'll have 10 different forecasts, and you'll say, how is that even possible? And because your assumptions drive your conclusions. If you get a bunch of economists, they have different conclusions, it's only because they have different assumptions. My assumption is that we're going to have a real recession. My assumption is that interest rates matter. My assumption is that the business cycle has not been repealed. And my assumption is that recessions and expansions are joined at the hip. And the good news is that recessions don't tend to last as long as expansions. They tend to be 2, 3, worst 4-quarter affairs. We get a real recession, the Fed's going to be cutting interest rates right back down to the zero bound. Yeah. We're going down 500 basis points. Yeah. We're going right back down to 0. I tell that to people, yeah. They look at me like incredulous. It's like these glassy eyes, like, you got to be kidding me. I say, look, with all due respect, and look, I mean that when I say it. We went down from 6.5 down to practically 0 after the tech wreck in 2003. Then we have the housing situation. We go from 5.25 down to 0. Then in the last cycle, now look, I'll just tell you right now, we were going into recession without the COVID. People don't realize that. That's why the Fed was cutting rates in 2019. They knew what was happening. Now, it would have been a different sort of recession.
Or David, they predicted, they knew something was going on over there. Because
of course,
if you look at the 10-year treasury.
COVID gave us a different recession, vertical down, and then vertical up. But I'm looking at the contours of the data, and that's why the Fed was cutting rates. They knew something smelled rotten in Denmark. Okay, They were cutting rates in 2019 before COVID, and then we go back to 0. So 2003 basically 0, 2009 basically 0, 2020 basically 0. And I'm telling these people, and they look at me because of course they're still stuck in the inflation. No. I actually spend my days thinking, not what are making the headlines today. I'm consumed with what will we be reading in the headlines 3, 6, 9, and 12 months from now. Sometimes 5 years from now. I'm thinking of the future. And so I think rates are going back down to the zero bound.
I agree with you.
I know that's that. No, I know. By the way, Jamie Dimon is never going to say that. Why would he? You know what that means for bank stocks? Not a good scenario. And so, but the good news is that if you have a strong balance sheet, you're in a good business. Look, there's going to be a situation where there's going to be assets that are going to be transferred from weak hands to strong hands. That is capitalism. But you will be able to once again refinance at much better rates within the next 12 months. So
David?
I think rates are going to come down a lot. And I say that because at heart, I am an economic historian. And I know what to look at, what's different and what's similar, because no two cycles are ever the same. But there are no new eras. And the cycle is the cycle. The business cycle, the market cycle, the interest rate cycle, these are the centrifugal forces, these sine waves that interconnect with each other. We are coming past the peak, Grant, of the interest rate cycle. Coming past the peak. It's just starting. 12 months from now, inflation, the economy, it's going to be a lot lower. And interest rates are just cyclical. When I talk about this with people today, they look at me like I should be carried out in a gurney.
No, I don't know why people are so committed to like. I think we're permanently going to see lower interest rates going forward than ever seeing these 6s and 7s. And hey, David, look, I want to be sure everybody gets Rosenberg Research, guys. Check it out. You can subscribe for free and decide if you want to get it annualized. Money to me is the second most important thing in your life to health. You need to figure it out. David's a great resource for that. I owe you a 2004 Chateau Latour. If you come down to Miami, I'll crack that with you. I can tell you'll appreciate it. And I'd love to have you on again, David. This is phenomenal information.
Well, I would love to, and actually, in Canada, we have winter 364 days a year. So I think that after today, any time getting out of Canada for any reason in the wintertime. So we could even do this together in Miami next time, as far as I'm concerned.
Let's do it. So you just tell me when you're coming down here, and I'll host you.
That'd be wonderful. And when you come back to Toronto, or I'm in Miami, we definitely have to get out. I was going to say for a few glasses of wine, but I don't know about you, but maybe it'll be a couple of bottles, depending on how long we're together.
Well, I can hang with you.
Great.
Hey, thank you so much, David.
Hey, Grant,
David Rosenberg, thank you for being on Power Players.